Have you ever noticed how every crisis begins the same way? Quiet, calculated, wrapped in elegance like a formula whispering its way into the bloodstream of the global market? The kind of elegance that blinds people right before it breaks them. That's the real hook. Not fear, not volatility, but the illusion of control. Because behind every smooth equation, every risk model with clean edges, there's a truth the market never admits. Math may describe the world, but it can also distort it. And when the distortion becomes the system, collapse isn't a possibility, it's a countdown. That's the logic I want you to sit with. The financial world doesn't fall because it miscalculates. It falls because it trusts the wrong calculations for too long. And once a model becomes gospel, people stop questioning until the ground shifts beneath them. That's when curiosity turns into survival. That's when you start asking the questions you should have asked before. Who built this system? Who benefits from its accuracy? And who gets buried when it snaps? Let that hang for a second. Because here in Underworld Capital, we don't worship formulas, we dissect them. We track the pressure points, the fault lines, the invisible incentives engineering every boom and every bloodbath. Subscribe and comment if you're ready to step into the room where these things are designed, not just consumed. Because once you see how the machine works, you can't unsee it. And if one equation could engineer trillions, what else is still lurking in the code of the global market, waiting for the right moment to detonate? The truth is this: financial theory never began on Wall Street. It started in dusty physics labs with men trying to model particles, not portfolios. Batchelor wasn't chasing money, he was chasing randomness. Einstein wasn't solving markets, he was decoding Brownian motion. But their equations bled across disciplines, slipped into the bloodstream of finance, and created a seductive lie. That uncertainty can be quantified, bottled, neutralized. That price movement is just another particle drifting through the void. Here's the logic Wall Street never tells you. Once you treat markets like physics, you inherit physics arrogance. You start believing chaos obeys you, and that's when the danger begins. Because beneath every clean distribution curve lies something feral, something no model can cage. That should unsettle you. It should make you imagine the market not as a system, but as a living organism. Unpredictable, reactive, violent when cornered. And the moment banks began pricing assets using equations born from particle motion, they didn't just import mathematical beauty, they imported fragility. Fragility that compounds. Fragility that waits. Fragility that doesn't reveal itself until the exact moment it's too late. So the real question becomes this: if markets were built on physics, what happens when the laws they rely on stop matching the world they claim to describe? Ed Thorpe wasn't guessing. He was the first to show that mathematics doesn't just measure risk, and it arbitrages it. His insight was brutally simple. If you can continuously hedge an option's D, delta, you can extract mispricing with near zero directional risk. That's not poetry. That's calculus. The foundation? Delta equals the partial derivative of the option value V with respect to the underlying price S. In plain terms, how much the option's value changes when the asset moves by $1. Hedge. The option by taking the opposite position in the underlying, adjust as prices move, and the randomness that terrifies everyone else collapses into something predictable, a drift term you can monetize. This was the moment math stopped observing the market and started cutting into it. When Black-Scholes went public in 1973, the weapon got industrialized. Because the formula didn't just price options, it encoded a worldview. The Black-Scholes value of a call option at time t is the current stock price times N of D1 minus the discounted strike price, that's K times E to the negative RT, multiplied by N of D2. But the real explosive component wasn't the closed form, it was the implication. If volatility is known and markets are continuous, risk is hedgeable. The industry swallowed that assumption whole. Options markets didn't expand, they erupted. Volume ballooned, leverage metastasized. Everyone suddenly believed they could neutralize uncertainty through delta hedging, gamma scaling, and volatility surfaces. And when everyone uses the same PDE. The core equation of Black-Scholes states that the change in an option's value over time, plus half sigma squared, S squared times the curvature of the price plus the risk-free growth term minus the discounted option value must sum to zero. That's the balance the market is forced to obey. Everyone is holding the same weapon, which means no one has an advantage. That's when the elite stopped following the equation and began escaping it. Jim Simons realized the fatal truth. A public formula cannot produce alpha, only conformity. And conformity breeds systemic fragility. Traders thought they were hedging risk. Instead, the hedges synchronized their behavior. The market learned the rhythm of their models, absorbed their flows, and waited for the moment when assumptions, continuity, liquidity, normality, would all fail together. That's the real tension you should feel. Not fear, recognition. Recognition that math doesn't merely forecast outcomes. When used at scale, it creates them. So the question becomes unavoidable. If equations can manufacture profit, what happens when they begin manufacturing collapse? While the rails debate plays out, another infrastructure story is moving behind the scenes. Let me introduce Unic, the platform that's changing the game in crypto trading. Unic's OTC exchange has already processed over $1.3 billion in OTC trading volume, giving both buyers and sellers the flexibility they need. With over 5.5 million active users and 500K plus followers on X, it's a platform built for scale. Please note that this is not financial advice. Once Black-Scholes proved it could price uncertainty, banks asked a darker question. Why stop at stocks? Why not price anything? And so they did. Mortgages, corporate loans, credit pools, everything became modelable, which really meant sellable. CDS markets expanded like a lung filled with toxic air. Securitization turned debt into tradable particles, and the derivatives market swelled into a grotesque shadow economy, hundreds of trillions deep. Here's the logic the industry never admits. When you turn risk into a product, you stop respecting it. You package it, stack it, leverage it, then pretend the math has your back. But math doesn't bleed. People do. That's why 2008 felt less like a crisis and more like a structural failure engineered by misplaced faith. When the subprime cracked, the elegant formulas broke instantly. Why? Because they assumed randomness, but panic isn't random. Panic is synchronized. Panic is contagious. Panic is what happens when millions of bets, all independent on paper, become perfectly correlated in reality. And as liquidity evaporated, the system revealed its true face, a machine built on borrowed time and borrowed money. Feel that heaviness, the recognition that collapse wasn't an accident, but an inevitability baked into the architecture. So here's the uncomfortable question. If one formula helped inflate a $600 trillion shadow market, what unseen structures are inflating right now? Today, the formula still exists, but now it's wrapped in silicon and trained on oceans of data. Black-Scholes didn't disappear. It evolved into neural networks, reinforcement agents, execution algos that move faster than human thought. Quant desks don't look for edges. They manufacture them. Jane Street squeezes MEV out of blockchains. Citadel slices microstructure down to the atom. Thousands of black box engines hunt the same inefficiencies, erase them, then hunt again. Here's the logic. As models grow more powerful, transparency shrinks. The system becomes sharper but also darker, and when no one understands the mechanism, no one can predict the failure mode. That's the part I want you to feel, not fear, but awareness. Awareness that markets are no longer free. They're engineered environments governed by algorithms optimizing for their own survival. And just like 2008, the danger isn't in volatility. It's in concentration. The concentration of intelligence, leverage, and execution inside a handful of opaque machines. The next shock won't come from a housing bubble or a credit freeze. It will come from a model misfiring in a system that can't afford even a single bad assumption. And when that moment arrives, you won't get a warning. You'll only get an outcome. Quick update on Unic. Their IDO for the UN token is live. The project markets a low FDV approach, referral rewards, and NFT perks for early participants. They present themselves as an on-chain OTC liquidity layer aiming to capture pre-market and institutional flows. Again, not financial advice. Check the link in the description for Unix token page and white paper before deciding. In the end, every model, every algorithm, every so-called breakthrough leads back to one truth. We built a financial machine that moves faster than human judgment. Markets aren't driven by people anymore. They're driven by equations reacting to equations, a chain reaction no one fully controls. And that's the real danger. Not volatility, not uncertainty, overconfidence. The belief that a system this complex can be tamed instead of merely survived. So as AI deepens the shadows and quant engines thicken the fog, don't ask, when will the next collapse hit? Ask, who will understand it before everyone else, and who will be left holding the debris? If you want the answer before the headlines arrive, stay here. Subscribe to Underworld Capital, drop a comment, and step into the only room where we dissect the machinery before it breaks. Not after.